Okay, so Celina Damian has worked for the state of California for almost 15 years in several analyst and enforcement positions. She has served different populations, including children, families, and low-wage workers, with focus on empowering individuals through education and outreach. Celina joined the Department of Financial Protection and Innovation as the newly established ombudsman position under the Consumer Financial Protection Program, and she spent this year, so working with other state and federal agencies to advocate for student loan borrowers. And so, again, thank you, Celina, for joining us. And I am going to go ahead and turn this workshop over to Celina Damian to share with us the presentation.
Thank you, Cheryl. Thank you, everyone, for being here tonight. Thank you for having me. I know everyone's super busy, but I am glad that you guys are taking the time out to really learn, educate yourselves, and ask questions. And I'm happy to be here. It's my pleasure. So thank you for inviting me. Please share this information. Student loans is something that affects a lot of people, whether it's ourselves, whether it's our families, our parents, our kids that are in college, our future college students, clients that we work with. So very important information, and I'm going to share my screen to start my presentation. Okay. So as Cheryl said, my name is Celina Damian, and I am the Student Loan Servicing Ombudsperson at DFPI. We're going to start with a little bit of background on student loans, sort of where we are, where we are with this crisis, some important terms that you will be hearing me talk about, and then we will get into the updates, and then just some other important information that I want everyone to have as well. We will have a Q&A section, and because we don't have a lot of participants, we probably will be able to get to everyone's questions. So you can put those in the chat, and I can't see the chat while I'm presenting, so I'll just go ahead and save those for the end. Okay. Let me see. Okay. Move this forward. Sorry. Okay, there it goes. So just a little bit about DFPI. We are the state's consumer protection agency. We used to be called the Department of Business Oversight, so you may have not heard of DFPI. It's a new name, maybe about 2 or 3 years old, but we have been around for a while. Our duties include to license and examine companies of financial products to ensure compliance. This includes student loan servicers who were just recently required to be licensed through our department. We investigate consumer complaints. This is regarding student loan servicers as well. So borrowers can file a complaint with our agency. We take legal action when companies are not in compliance, conduct education and outreach such as this one to enhance awareness and protect consumers from fraud and abuse. So let's talk about some student loan debt numbers in California and how it affects Californians. So there are 4 million Californians that owe $156 billion in federal and private student loan debt. Most of that is federal debt. In the years 2019 and 2020, so this is pre-COVID, 46% of California college graduates had student loan debt. 35 to 49-year-olds owe the most debt on average. The average debt load of a California borrower is about $38,000, with women acquiring more debt. Prior to the pandemic, approximately 500,000 borrowers were behind on paying their loans. And in the US, student loan debt is now the second highest consumer debt category after mortgages, totaling nearly $2 trillion. In the last 10 years, the amounts have increased substantially, the amount of debt. And you may ask why? Well, there was a lack of protections, a lack of a lot of things, which is why we are in the crisis where we are now. You may have been hearing about it in the news, advocacy organizations, agencies really pushing for reform. Historically, borrowers did have protections on the federal level. These rights and protections were determined by the Higher Education Act of 1965, but they were very limited. Borrowers were faced with navigating a complex system plagued with predatory practices, untrained servicers and their staff, and as well as predatory for-profit schools. There was a lack of oversight of the administration of federal student loan programs by the Department of Education. And the servicers, who are the borrower's main point of contact, were found to routinely lose paperwork, misapplied payments, provide inaccurate information, and steer borrowers into forbearance or deferment, which added to the overall cost of their loans. I've seen borrowers over and over again that have already paid their initial balance, whatever they took out years ago, and for some reason they don't see a change in their balance. If anything, it's increased. So this is the reason why many times this was happening. These unfair and deceptive practices cause borrowers' balances to balloon and cause them to slide towards delinquency and default. And then additionally, so we have on one end, we have this system that's not regulated, basically the student loan system that's just unregulated. And then to add to that, there's an outsized impact or disproportionate impact on students of color. Again, there could be many reasons for this, but mainly because there's a lot of first-generation college students who don't have the economic means to pay for college out of pocket, or parents or family to assist with the high cost of education and with the increase of it every year as well. Therefore, they're forced to take out more loans. 90% of Black and 72% of Latinx students take out college loans in comparison to 66% of white borrowers. Black borrowers take on nearly 50% more debt for a bachelor's degree than white peers. Black women have the largest student debt burdens of all. On average, 20 years after starting college, a Black borrower still owes 95% of their original student debt balance, while the white borrower has paid down almost 95% of theirs. Delinquency and default rates are higher for Black and Latinx borrowers. And research has shown that a borrower in a 75% minority neighborhood is 5 times more likely to fall behind on their student loan payments. This results in it affecting their credit and them being able to not finance vehicles, pay other bills, daily expenses, buy property, buy a home. So it really impacts students of color more, but it really is an issue that finally the Department of Education has taken notice, and they're attempting to reform the system, but there's still a lot of work. But this is some of the reason why these numbers are so high. In 2019, California took a step forward. They established protections for student borrowers and introduced the California Student Borrower Bill of Rights as Assembly Bill 376. It's a bill that applies to student loan servicers doing business in California, and this includes state licensed servicers. It applies to borrowers with both federal and private loans, and it was codified as Civil Code Section 1788 in the Civil Code. California is only one of 13 states that has established this advanced legislation to strengthen oversight of student loan servicers and protect borrowers. This is really important because those protections on the federal level are just simply not enough. A borrower that encounters a servicer that is acting unlawfully can file a complaint with our department, and if needed, then we can file enforcement action against a servicer. And this is a brand new bill. What it did, it prohibits servicers from engaging in abusive, unfair, or deceptive practices. Those practices that I just mentioned earlier that caused borrowers to slip into default, that cause these ballooning balances. It requires that servicers work in the best interest of borrowers and provide accurate information. Previously, all they were doing when a borrower was calling and asking for assistance or for help, they would just place them on forbearance and deferment without telling them what the consequences of that would be. They have to help borrowers get on a correct payment plan. They have to be able to advise borrowers of these programs, train their staff appropriately. This bill also establishes special protections for military borrowers, borrowers working in public service, older borrowers, and borrowers with disabilities. In addition, this bill also established my position. So I'm working hard to make sure that people know that they have these protections in addition to everything else, because this is something unique to California and borrowers. So let's talk about some key terms or go over some key terms. When you take out a student loan, you're going to be basically dealing with two different agencies or two different entities. The lender. So the lender is the company or the organization that's lending you the money, or the borrower the money. They originate the loan. They set the terms of the loan. So this could be the Department of Education, if it's a school providing a private loan, if it's the state, or in a case of a private loan, this is going to be the bank, the credit union, if you're taking out a non-federal loan. The student loan servicer is the company that sends the borrower the bill each month. They collect and process the loan payments. They track the loans while the borrower is in school, processes all these changes in the payment plans, deferments, forbearances, or other activities to prevent default. And as I said earlier, they are essentially the borrower's main point of contact. When a borrower calls to find out when their payment is due, this is the person that they're, or the entity agency that they're talking to. They're the servicers. The lender, the Department of Education contracts with servicers, which are going to be those Mohila, AES, FIA, those Navient has both private and federal loans. So those are going to be the borrower servicers. So it's really important to understand that. So the interest is the money of the amount of money a lender or financial institution charges for allowing the customers or the borrowers to borrow the money. The federal interest rates for student loans are set by Congress each year on federal loans. Capitalized interest is unpaid interest that is added onto the loan balance after periods of non-payment, forbearance, or deferment in this case. So this is why we see these accounts, these balances increasing, because it increases the loan's principal balance and interest is charged on the new larger balance. Consolidation, it's a process where you can combine your federal student loans into one larger one. So you can have older loans, maybe loans that were dispersed in 2009, loans that were dispersed, then you went back to school, had additional loans in 2014, then went back to school 2020, and you just want to combine them into one loan. You're able to do that. Consolidation is similar to refinancing, and it is something that we really advise borrowers to really look at carefully and not just consolidate to get a, because it will change your interest rate and it may increase the overall balance. Right now, with all the changes going on, you will hear me talk about consolidation, and it's only because during these, with these programs, with these updates going on, consolidation is necessary, and the Department of Education has provided guidance saying that borrowers need to consolidate. However, normally, typically outside of this year and all these relief and forgiveness programs, it's something that we really, you want to sit down and consider and look at, see if it's something that benefits, benefits the borrower. So delinquency, it's when a federal student loan has one or missed payments fewer than 270 days. At the 90-day mark, servicers report late payments to the 3 major credit bureaus. So it's delinquency first, and then after the 270 days, a borrower will be declared in default. Once in default, the entire balance of the loan becomes immediately due. This is called acceleration, and the loan holder can begin collecting on the loan through garnishments or withholding of federal tax payments. There are 2 ways to get out of default. One is through rehabilitation. It's a one-time opportunity that the borrower has. The record of the default will be removed from the borrower's credit history. However, the credit history will still show late payments that were reported by the loan holder, which would be the Department of Education, before the loan went into default. It will eliminate additional collection costs. Then consolidation is another way to get out of default. When you consolidate to get out of default, the record of default will remain on the credit history. Late payments will remain on the credit report for 7 years from when they were first reported. And then forbearance and deferment, I won't get into this too much, but basically these are pauses to your student loan payments or account freezes. For example, we have one that's a one-time COVID forbearance. This is not typically why they are granted. Usually it's granted through the servicer for periods of up to 12 months at a time. The borrower applies to the loan servicer for forbearance, and they must continue making payments until they receive confirmation. Private student loan forbearance varies. It's more limited and may cost borrowers money. Then deferment is a temporary pause to student loan payments for specific situations. Borrower might seek a deferment for active duty military service, and the U.S. Department of Education has a list of qualifying reasons. When a borrower goes back to school or is in school, there is an in-school deferment automatically placed on their account. And then just some financial aid key terms, grants. This is for information for borrowers that are, or students that are seeking financial aid. Grants is aid awarded on the basis of financial need. It does not have to be repaid. Federal work study is money that you earn from a job to help pay for school expenses. Again, does not have to be repaid. Scholarships awarded on the basis of academic merit and awarded by college or other organization. These do not have to be paid back most of the time. And loans is money that is borrowed, what we just talked about. What we advise, and a lot of my outreach and education is on really advocating for students to exhaust grants and scholarships prior to obtaining loans. There are so many scholarships that go untouched. There are scholarships for so many different reasons, and it's important that students do their research and try to exhaust those before they take out student loans. If you are taking out to student loans, there are different types. Well, there's our federal and our private loans. For federal loans, the U.S. Department of Education is the lender, like we spoke about earlier. The interest rate is fixed. Direct loans, Stafford loans are the main loans that are being provided now. After 2010, all loans provided by Department of Education are direct loans. They can be either subsidized or unsubsidized, and the difference between those is that subsidized loans is that the government is paying the interest while the borrower is in school and the interest is not accruing. Unsubsidized is that the borrower is accruing interest while they are in school. From the minute it's dispersed, they're paying interest, so therefore whatever they accept, whatever loans they take out at the beginning of the semester will probably be different by the end of the semester, by the time they finish with school. There are direct plus loans. These have a fixed interest and they're not subsidized. So again, they're accruing interest. A credit check is required for these type of loans. There's two types of plus loans, graduate plus loans. So these are for students pursuing graduate degrees. And then there are parent plus loans that are available to parents of undergrad students. Parent plus loans come with a lot less forgiveness options and repayment options. With parent loans, I think the thing that I want to stress most importantly for people that are considering taking out loans for their children or maybe for their grandchildren is that parent plus loans, they're easy to acquire, but they come at a little bit higher cost. Unfortunately, there is no type of income requirement. You could be making, minimum wage, and they will let you take out as much loans as you need to cover whatever the cost of the school is. So there is no limit, which can help the student get through school and graduate, pay it, but paying it back could be prove to be a little bit more difficult. Parent Plus loans accrue interest differently, and I would just really recommend just sitting down and just ensuring that Parent Plus loans is right for the parent, the grandparent. I've talked to borrowers constantly who are elderly, getting ready to retire or wanting to retire, and they can't because they have a Parent Plus loan from 1990 from their parent, their grandchild, from their child, their grandchild, and they have just had such a hard time paying this. The payment plans available for these loans they cost higher, and they look at income differently. So it's just really important to just really be careful when taking out these Parent Plus loans. Again, exhaust all the scholarships, everything else. There are direct consolidation loans, which is what we talked about earlier, when you're able to combine all your eligible student loans into one single loan. There's no cost to the borrower, but again, it may increase the total balance of the loan. So really look at the terms. When you consolidate, it'll tell you what your new payment is, what your new interest will be, and what the total balance is. When you consolidate, they'll take a weighted average of all your loans. So I have messages of borrowers saying my interest rate is going up. I have a loan with 2% interest, and now it's going up to 4 or 5. Well, it's because they're taking a weighted average of all the loans. Then you have your FFEL and your Perkins loans. Again, the FFEL loans are no longer being provided, but we still have a lot of borrowers that have these FFEL loans. And you'll hear me referring to these when I talk about the student loan updates. They were discontinued in 2010. These are made by private lenders, but they are insured by the government. So there is still some protection, and they're not considered private loans. Perkins loans are the ones provided directly by the schools, and these were discontinued in 2017. But again, still many borrowers that have these FFEL and Perkins loans. And then private loans, they're the ones made by banks, credit unions, state agencies, or schools. They're not funded, subsidized by the federal government, don't offer the flexible repayment terms and forgiveness options. They often require an established credit record or a cosigner, and they're generally riskier than federal student loans. Again, students and parents should always exhaust federal loan options before considering a private loan. We have a lot of borrowers who also refinance into private loans. Again, read the terms. You may have lower interest, but in the long run, you have to look at your financial plan. I have borrowers that reach out to me now, and they were trying to do the right thing, pay off their loans. They refinanced into a private loan. Now they don't qualify for all these relief programs, forgiveness programs that now are being reformed. And there is, once you refinance into a private loan, there's no way to go back and undo that. The same with consolidation. So again, just make sure it may be for somebody, it may not. It just really depends on their situation, but we just want to provide the information. And I think the main takeaway is just really understand the type of loans that you're taking out. A borrower should borrow less than the school offers, and then they can request more funds later if needed. So only borrow what they need. A loan is a legal obligation, and a borrower and cosigner is responsible for paying the amount with interest. Keep track of how much you're borrowing, understand the terms of the loan, and copies of the loan documents. If you are a parent, communicate with your child, communicate if you're helping someone, maybe go through the process, sit down with them and really help them understand what is it that you're taking on. This is, although it may not seem like a large amount, it could be a loan that you carry for 10, 20, 25 years. So it really is a large commitment. Research starting salaries in your field. So for example, if you want to be a teacher in California, and teachers could earn, depending on the area, maybe 40 to 70,000 it just depends. And you're going to a school where you're taking out $150,000 in loans, and you're going to end up with, in the long run, even more loans than that. I mean, is that reasonable for you to take on that much debt? I mean, really do your research. And I think now that we know exactly what this entails, taking on this huge debt that could impact you down the line, it's really worth it to just sit down and find out this information. My child just graduated from college about 2 years ago, and I actually sat with them through every semester. Well, didn't sit there, but went into the account. I accepted the aid, the loans, and he only came out with $8,000 in loan. And this is loans. This is because I was sitting down and I was accepting the aid, and I'm a single income household. He worked, he did whatever he needed to do. But now he has peers from school or other students that came out with $30,000-$40,000 in loans, and now they're stressing about repayment start. And so really the only reason I mention this is because sometimes you do have to sit there and help them if you're a parent and are trying to get your kids through this complicated program. We want them to succeed. We want them to go to school. We want to take advantage of all the aid that is available. But we really want to do it in an educated and responsible manner. So now let's talk about the federal student loan updates. I know everyone's eager to hear about this. These updates, these programs, again, apply to federal student loans. Okay, so the first one is the pause, the COVID pause. So under the CARES Act, which began, this was effective about March 2020, student loan payments were paused and interest rates were set to 0% for eligible federal student loans. So these were borrowers with direct loans or loans owned by Department of Education. This was done automatically. There was no one needed to call a servicer. If someone just automatically had their loans paused, and they know they have direct loans or loans owned by Ed or Department of Education. It required servicers to report to credit reporting agencies as if regularly scheduled payments were made, and they were reporting $0 monthly payments on the credit report. Regardless of relief or forgiveness, borrowers should prepare for repayment starting January 1st, 2023. The last extension was just announced, and this is going to be it. I believe there were 8 extensions that were made. So regardless of all these other relief and forgiveness options, borrowers need to be prepared for repayment. I was just reading a report from Equifax and other agencies that was saying that there was an increase in consumer debt, and the borrowers that will be affected more with these payments are those borrowers that just came out of school during the pandemic and they've never made student loan payments, so they haven't really budgeted for it. There were a lot of changes during the pandemic with incomes, with jobs. And so it's really important for borrowers to contact the servicers, get themselves on an income-driven repayment plan, and really just budget. We don't want people thinking, oh, this relief is coming, this forgiveness is coming, so it'll be forgiven. The way that the Department of Education or just government agencies work, there may be delays, there may be glitches, nothing. Although it's in the law and it's in the news, and they've said we're going to do the relief and the forgiveness, we still want borrowers to be prepared. During this pause, there were a lot of changes in servicers, so a lot of accounts were transferred from one servicer to another because some servicers left the student loan business. So therefore, some borrowers may now realize that they're with a different servicer, and I get that all the time where they say, I don't know who my servicer is. Well, you log on to the studentaid.gov website, create an account, and you'll find that information there. But important just to be prepared. Another update that was made that will be rolled out in the fall. Now they may be pushing it back a little bit farther because of the relief. Borrowers will receive credit towards income-driven and PSLF forgiveness. So there is another lesser-known forgiveness program. It's called income-driven repayment. Basically, when borrowers are on an income-driven repayment plan for a period of 20 or 25 years, they will have their balance forgiven. similar to the public service loan forgiveness, except this one doesn't require that you work for the government. Again, because of all the problems that we were having with the servicers and tracking of payments, tracking of forgiveness programs, the Department of Education is going to give credits to borrowers with direct loans and FFEL loans, those older loans. Once they consolidate, they're going to be giving them credit for any month where they made payments, regardless of the payment plan. They will be giving them credit for months of forbearance, or 12 months of consecutive forbearance, or 36 or more months of cumulative forbearance. Again, this is not something that they typically do, but because they are trying to reform the programs and trying to alleviate some of these issues with the servicers, they're doing this adjustment. Months spent in deferment prior to 2013. The Department of Education is estimating that this will help about 4 million borrowers get closer to either IDR forgiveness, PSLF forgiveness, or eliminate their balances completely. So this will probably benefit borrowers that have been paying for longer periods of time. Again, those older FFEL loans for periods of 20, 25 years, which there are still a lot of borrowers with those loans. Another program, the Fresh Start program. This one is for borrowers that are in default and will help approximately 7.5 million borrowers. A borrower does have to opt in to the program, but the loans that are eligible for Fresh Start, again, those direct loans. So it's defaulted direct loans, defaulted FFEL loans owned by the Department of Education, and Perkins loans held by Department of Education. The benefits of the Fresh Start program is that borrowers will be taken out of default when they opt into the program. They'll have access to income-driven repayment plans that provide more affordable monthly payments. So those are income-based plans. So they take your income, you certify once a year, and then they base your payment on that. Some borrowers could have a $0 monthly payment on those plans. Borrowers will regain access to Title IV federal student aid, including federal student grants, loans, or work-study funds. They won't be subject to any collection efforts or collection fees, and they will be eligible to rehabilitate a defaulted loan if they rehabilitated during the COVID payment pause. What will it do for their credit? Well, it will delete the loans from the credit report after 7 years, report all other defaulted loans as current and not in collection status. It will use a loan's original date of delinquency if the borrower becomes delinquent or goes into default again. So it will not reset the borrower's 7-year timeline. So if they get into the program and then maybe halfway they lose track, or for some reason aren't able to keep up on the payments, they will use the original date of delinquency for the credit report. As of July 10th of this year, Department of Education removed default notations from the CAVER system. So it's the Credit Alert Verification Reporting System, which many banks use for other loans and such products. The program will last for a period of 1 year from the end of the repayment pause. It will start January 1st, 2023, and will go through the end of December 31st of next year. Borrowers have to take action, so they do need to call their servicer for Department of Education for federal loans. It's going to be the Default Resolution Group, and they do need to opt in. So this is really an important benefit. It's Fresh Start. It's basically doing hopefully will do what it's called. It'll give people a fresh start and let them get back on track to get these loans paid, or if they can get into a different program. Then the recently announced Biden student loan cancellation. So this is separate from these other initiatives that I talked about. So the president announced $10,000 to $20,000 of relief for student loan borrowers. Okay, what are the loan requirements? Borrowers have to have federal loans. So these could be the undergrad, the graduate direct loans, Parent Plus, and Grad Plus loans. So direct loans can be the subsidized or subsidized. It doesn't matter as long as they're direct loans. Those Parent Plus and Grad Plus loans, FFEL and Perkins loans held by Department of Education. There's still a few of those. defaulted loans also qualify for the relief. Commercially held FFEL loan borrowers need to consolidate their loans to benefit from cancellation. So again, these are these older FFEL loans that I've been referring to. These loans had to have been dispersed on or before June 30th of this year of 2022. So that means that a borrower could have been in school as of this last spring or winter, and they could benefit from this relief. Then they're going to look at income requirements. So if your taxes or adjusted gross income is less than $125,000 for an individual or $250,000 for married or head of households, they will be looking at both years, and they will be taking the year with the least income, and that will qualify you. Once you meet these 2 or 3 requirements, but mostly the 2 requirements about the loans and the income, then you will have to look at whether or not you received a Pell Grant. So if a borrower received a Pell Grant anytime during their education for any program through any school, even just once, they will qualify for $20,000 in cancellation. If they did not receive a Pell Grant, they will qualify for $10,000 in debt cancellation. The Department of Education has information on everyone who has ever received a Pell Grant. So there was a little bit of a concern that they only went back a certain amount of time, but they have now clarified that they have that information. How will borrowers be able to apply? Well, they will have to create an account on the Federal Student Aid website. There will be an application available starting early October. We don't know a date yet. I just met with Department of Education yesterday, I believe, where we had a meeting, and it's still being rolled out in October. They do have income information for 8 million borrowers already. So these are borrowers that completed a FAFSA in the years 2020, 2021, or that certified their employment for one of these IDR plans. Because we don't know who these borrowers are, we are still advising that when this application rolls out, that they go ahead and fill it out anyway. It's going to be a self-certified income type of application. Nobody has seen it yet, but it will be available early October, and it will be available through the end of 2023. There will be a large rush of people trying to apply this year, and Department of Education has advised that you apply before November 15th if you want your loans canceled, or if you want this cancellation to go through by the end of the year, so you won't have to start repayment January 1st. Maybe you'll have a 0 balance, or maybe your balance will be lower. So they have said November 15th as the date, but it will be open for the rest of next year. Some borrowers will automatically receive a refund if they made payments during COVID forbearance. So prior to all these announcements, some people were just trying to get ahead of their accounts. And since there was 0 interest, they were making payments, not knowing all these things were happening. So some borrowers will receive automatic refunds if they were part of the payment pause and they still continued to make payments. So let's say you were making even $100 payments for each month. You would get, if you qualify for $10,000 in debt, that would cover your balance that you had. They would refund you that money and then pay off the student balance. This is the website for more information on the one-time cancellation. Again, the application is not available yet, but it will be available through the end of next year. Okay. Then there has been a lot of on the news about PSLF, or the Public Service Loan Forgiveness Program. This was a program that was created in 2007 to encourage individuals to enter and remain in public service. Under PSLF, student loan forgiveness is granted after satisfying certain criteria for 10 years or 120 months. Basically, it's what it is. You have to have the right type of loan. You have to be on the right type of repayment plan, an income-driven repayment plan, the right type of employment, and the right number of qualifying payments. So those type of loans, again, have to be those direct loans, the right type of repayment plan, IDR plan, right type of employment. That has not changed. A government or public or public employee or nonprofit employee. So 501c3 is a agency is a qualifying employer. For government, it can be state, city, municipal, tribal, military. You could be with a water district, library, fire department, and you can be in any position. You don't have to be in a certain position. You can be in maintenance and legal and teaching, in any position as long as your employer is a qualifying employer. And then you have to have the right number of qualifying payments, which is the 120 payments. In last year, October 31st, this waiver was created. Again, as a result of all these problems that were created by the lack of oversight. The servicers were not tracking were not tracking payments, were not doing what they were supposed to do to help borrowers with this program. In 2017, when the first batch of borrowers applied for PSLF, there was a 99% denial rate. So then they said, hey, what's going on? Well, servicers weren't getting people on the right plan. They weren't telling people, just not informing them correctly. This waiver was created and open for a year. So what this waiver does is it allows borrowers to receive credit for payments that previously did not qualify for PSLF by allowing them to consolidate the FEL Perkins loans into direct loans. The CARES Act forbearance months count towards PSLF. So right there, if someone's applying for PSLF, they've already got about 30 months of qualifying payments, as long as they're employed at the same time. Past periods of repayment, whether or not borrowers made the payment on time for the full amount due or on a qualifying repayment plan, will count. This, along with the IDR adjustment that I mentioned earlier, will get people closer to the 120. So previously, if a borrower was a day late because the servicer didn't post the payment on time, if they were 1 cent under, if they made payments ahead of time, again, trying to get themselves, get on track with their payments to lower their balance, they were not receiving credit towards PSLF. So they were losing out on a lot of months of credit. So people thought they were already on their way. They thought they were making payments, working their 10 years, and then come to find out they weren't. So this waiver was created to alleviate that. So if a borrower, and then also current qualifying employer is not necessary, which is also part of the waiver. Traditionally, you have to be working with that employer. When you are granted forgiveness during the waiver period, you don't. So that benefits workers that maybe moved on from public service or retired workers. The waiver expires October 31st of this year, so in about a month. What do borrowers have to do to qualify or find out if they qualify? So first of all, what you need to do is find out, do you have a qualified public service employer? The FSA, studentaid.gov, has an employer search tool where you can look up, using your employer's federal employer ID number. You can go on there, enter the number, and they will tell you if they've already been certified. So if they're already in the system, it just makes it a bit easier. That means that someone from that agency, that company, has already received forgiveness or is already on track for forgiveness. So that's one thing. So the borrower will need the federal employer ID number, which is the one on the top number on the W-2 form. For the nonprofits, for a lot of the companies, maybe it was a company that somebody worked for previously, you can always just Google that company name and then FEIN, and you will find that number online as well. A borrower needs to find out what type of loans they have. This is extremely important, I think, for all these programs, to start asking for help or really finding out what their strategy is, because it's really what it is. Again, through studentaid.gov, they will create an account. They can download all their aid data. They will see the loan information, and before every loan, they will see the word direct, they will see FELP, or they will see Perkins. That will tell you immediately what type of loan you have, and then you know what steps you need to take. For public service loan forgiveness, if you have Bell loans or Perkins loans, and you want to include them with your newer direct loans, or you want to get credit for those older payments that you made previously after 2007, of course, because that's when the program began, you will need to consolidate those loans. Once you consolidate, you complete the PSLF forgiveness and certification application. This is what it looks like. It's a 2-page application. 1 page is basically your information. I believe I qualify, or I want to find out. And the second is the employer certification form. So being that we are so close to the deadline and with the backlog that they have, what we are advising borrowers now is that they use the PSLF help tool. I have included all this information at the end of the PowerPoint presentation, and I will provide a copy of this to Cheryl also to share and to have those links. But FSA has a help tool where you can fill out the page 1, and they will basically track that, and they will see that you've used the tool. Then you have to download it, print it, and get it. You'll need a wet signature from your employer. So as long as you've used the help tool and that date is dated, your employer's dated those before 1031, you will benefit under the waiver. The same thing with consolidation. If you need to consolidate, you need to jump on the FSA consolidation link and do that consolidation through there. And then as long as it's done prior to 1031, you will benefit under the waiver. So at this point, if someone starts the process, do not expect to get an answer or a response probably for the next few months, just because of the backlog. And right now their priority is the relief, although this is just as important, but there's just a lot of things going on. For this certification form, the only thing I can suggest, again, make sure that FEIN number is correct. That's very important. You do not want to have any denials because of a one missed number, which I've seen. They get returned, it's denied because of a signature that's not legible or information that's not legible. If you have multiple employers, you will need multiple employer certifications. The tool can help you with that. It will tell you, you'll be able to list your employers, and it will print out the paper sheet for you. All you will need is to get their signature. Let me see on this. So you need just the signatures. Make sure the dates are complete. If you write the date and the year, they're not going to accept that because we are qualifying months, so they can't just take a year. If you're having a hard time certifying employment, really try to do your due diligence. You don't want to be on the backlog of waiting for Department of Education to do an investigation, to find out, to pull out your W-2s, request those, and then go that way. If you need help, what I've asked borrowers or advise them is email me. I'll send a friendly email to the employer. As long as you get me an email, I say, hey, I'm helping this borrower. They're trying to get this certified. Can you send me a contact person? Smiley face. And within 24 hours, I'm getting a response and helping borrowers get these signed. Sometimes unfortunately, they're understaffed or whatever it is, and they just need that little nudge. So I'm trying to help in that sense. But if the employer really has closed down, then an employee can go ahead and submit W-2 forms, note that information in the help tool, and then they'll have to sort of wait in a different line. But these are extremely important, and just 1031 is the date for consolidation and submitting that app, or at least using the tool. This is the federal student aid page. I know I've been mentioning it a lot, the studentaid.gov. This is where a borrower will create an account. So they'll need this for the Biden relief. If they consolidate, to find out who their servicer is. So this is going to be really essential for a borrower. Then the servicer will also has an account or a student portal or borrower portal. There they will have information on their actual payment. This one doesn't really say like when your payment is due, and that information, it has overall payment information. On your studentaid.gov account, you can also see under your loan data, you can also see your grant data. So if you're curious about whether or not you received a Pell Grant because it's been so long, you can actually look on here and it'll tell you whether you received a Pell Grant. And then you'll know also for the relief. So the Biden relief under here, the public service loan forgiveness, your account consolidation is under this page. Okay, so this is going to be like the go-to landing page for everyone. One thing that we're coming across a lot, and it's something that we don't typically think of, but students loan scammers, they're on overdrive right now, unfortunately. So whenever they see an advantage or they see something going on, they take advantage of it, and that's exactly what they're doing. So many borrowers are confused, looking for payment options, looking for quick assistance, just trying to find out. What they're doing is they're reaching borrowers by phone, text, emails, and mail with official looking logos. They promise to reduce or eliminate student debt. They're offering quick loan forgiveness and really pressuring borrowers, saying, you know, we have this program, we're going to help you. We're promising loan forgiveness. And somehow some of these scammers already have borrower information. We don't know exactly how that's happening, but the Federal Trade Commission and the Consumer Financial Protection Bureau is aware of it and are putting out alerts for borrowers. They're targeting, and unfortunately I've talked to some of them, elderly people and people that are just really just like in dire need and don't speak English. They're calling and saying, is this, they'll send me a message and say, did you call me? Is this you? I tell them, send me what you have, send me the information. So I would advise, I mean, this is really important. We don't want people to get scammed. They are asking for payment. They are asking for personal information. There could be identity theft. So, and are asking for FSA ID username or passwords. Tips to protect yourself to know is that what is important to know is that there is nothing that a debt relief company, which is what they are, they're paper processing companies or application processing companies. They may have legit websites, and they do, and they're licensed by the state, but they're processing applications for people. But they're not providing what they're promising, because they can't guarantee forgiveness. They can't guarantee relief. The only ones that can do that are Department of Education, and everything that they're offering a borrower can do for free. They're having them subscribe to these programs where they're charging like $300 a month for 3-4 months and saying, oh, we'll get you forgiveness, but then a borrower can't even get in touch with them. I'm helping an elderly borrower with that right now. What I can tell people is that the Department of Education and your servicer does not have time to call you 3 times a day. They don't have time to text you. They don't have time to sit there on the phone. You can barely get in touch with them. So studentaid.gov is the page. If you do get anything, log on to your servicer website or studentaid.gov and see what's going on with the account of your, with the status of your loan. Don't subscribe to anything, and you can file a complaint with the FPI if you have been a victim of fraud. I reached the end of my presentation. This is my contact email. You can email me. You can send people to me if you need help, assistance. The only thing I ask is if they're going to send me a message requesting help, if they already have some information on their loans, because I get a lot of emails saying, please help. What do I qualify? And that doesn't help me, because we need to know what they're looking at, what program and what kind of loans they have. Our link, if you want to file a complaint, and then just other information for our student borrower resource page. We have some great webinars on YouTube, and then links for the studentaid.gov, which I've been mentioning. I've mentioned numerous times tonight, but that's it for me, but I'll stop sharing. And wow, we got through it.
Wonderful. Oh my goodness. That was a lot of information. Thank you so much. I really don't see any questions in the chat. So I am going to, unless I'm missing it, I've been monitoring the chat as you were talking. Hold on. I am going to unmute. I have unmute folks. So if there's anyone in the on this webinar who has a question. Will the PowerPoint be provided, Lauren? Yes. As I shared earlier, we are going to put it on our website. I'm going to provide our website information in here, just treasureisland.org. And also I'm going to include my email address as well. So if you guys are not able to access it from our website, just to shoot me an email and I'll make sure you guys get it. So here's my email address in here.
There's mine as well. And if anyone works for an agency, they want us, myself, or an outreach team to do a presentation for your staff, for your client, you know, the clients, your community, we're more than happy to also provide a presentation or, you know, do one.
Okay, let's see. Julian said, it said disregard my last emails. Okay. All righty. So Julian, I guess you were trying to get it. Does anyone here and has a question for our presenter? Now is the time to ask because she's the expert. I'm not, which is why she's here.
And I have time, so.
And she has time. She hasn't, yeah. So please. Oh, someone has a question here. Okay, let's see here. Hold on one second. I see a question here. So it says, hold on one second. Give me a second. I guess Shirley had a question.
So yes, about consolidating the loans. Yes,
yes, you saw it. Yeah.
Yeah. So it will make.
Go ahead.
Oh, I'm sorry. So it will make you eligible for only certain repayment plans, and of course, it will change your payment. So what I would suggest with that is that on the studentaid.gov, there's it's a student loan simulator where you can actually enter your data. You don't have to create an account for anything for that, but you can use it and it'll tell you exactly how much your payment would be if you consolidated with the spousal, with the loan, with your spouse.
Okay.
But yes, it will change your options as far as what you're able to enroll in for payment plans.